Good afternoon and welcome to this FSC Connect webinar. It's just gone 3:30, so we're going to kick off and start talking through today's topic, debt, credit and the cost of living in New Zealand. My name is David Bishop. I'm the Chief Marketing Officer here at the Financial Services Council, and I'm delighted to be able to present and facilitate this session today. Just as a way, I'll start to introduce the session. I think we're all aware of the enormous financial challenges New Zealanders are facing right now, and certainly some of the data that started to prick our ears up were around the debt and credit data, and indicated that more arrears are on the rise. So we wanted to sort of see if we can explore that a little bit more in this webinar. So, if I think back to last year's FSC conference, our economist panel there was predicting pain was on the way, and obviously the recent news cycle has been talking about cost of living crisis for some time, and with the raising of the OCR on one hand a couple of weeks ago, and just the everyday price of things impacting how our spending day to day. Indeed, the International Monetary Fund last week predicted that New Zealand is going to do it tough for the next couple of years, and it's a global trend, unfortunately. So, there are those that are trying to save, but there's a real tension here between short-term needs and long-term savings, and it's starting to translate as we look into the world of credit and debt. And the headline data from Centrix last month showed that about 12% of Kiwis are currently in arrears, and it's a worrying trend, and it's a trend we're seeing across quite a few of our indexes, and the Financial Services Council actually produces a yearly financial resilience index, and this is kind of starting to show us that the number of Kiwis that can't find $5,000 in an emergency in a week has risen. It's about 1.5 million according to our data, and it spreads through into retirement as well, where a third of respondents identified that they can only maintain their lifestyle for 5 or less years on the remaining retirement savings. So, as we start looking at this, people are doing it tough. People are reporting issues that they're either having or close to having issues with credit card debt and buy now, pay later debt and personal loans from our research and the Centrix research that Monika will go through soon will help to paint a picture of that. And we also know that support networks are important. And one of the facts that really interests me in the resilience index is that lots of New Zealanders have turned to their family, their friends, their family when it comes tough. But as more people are doing it tough, where do we turn? And so this session will look at how the economic situation is prevailing itself through two lenses. The first, the state of credit, and then the second, from the ground view of where everyday Kiwis are in terms of debt. So on that note, I'd like to welcome Monika Lacey, the Chief Operating Officer of Centrix, it's the Credit Bureau of New Zealand, and alongside Monika, Christine Liggins, the CEO and co-founder of DebtFix, who provide debt management advice and solutions for people having varying levels of consumer and business debt. So before I ask Monika to kick us off, I'd just like to let you know that the Q&A function and chat is open. So please do ask questions as we go through the seminar, and I'll be glad to ask those of our panelists, Christine and Monika. But Monika, on that note, I'll hand over to you and welcome. Thank you for joining us. And yeah, just to introduce yourself and look into the Centrix data.
Thanks, David. It's a real honour to be here today to share our credit insights. So I thought I'd kick off today's session just by talking a little bit about a credit reporting agency and the types of data that we collect, so that can sort of put a really good foundation down for when we start talking about the insights. So for your benefit, Centrix is New Zealand's only locally owned and operated credit reporting agency, and we collect data from a lot of disparate sources and we bring it all together into a single view. So when a credit provider does an assessment of an individual or a business, we can give a really solid picture of what we know about them. So some of the data that we collect, CCR, which is comprehensive data, which is payment behaviour information collected from a number of sources that tells us how individuals pay their commitments. We also collect credit inquiries. So if I apply for a loan somewhere or a power account, often those businesses will run a a credit check on the individual, and that's what we count as a credit inquiry, which is a good indicator of credit demand. And of course, we also get default information. So these defaults come from a lot of debt collection agencies, and sometimes credit reporters themselves load defaults, and that's an indication of a very severe delinquent position. So often the business has actually gone through a lot of process internally to try and collect the debt, and it's sort of at the end of that journey that they just use the default loading as a last resort. In addition to that, we also collect some information from government agencies such as bankruptcies and insolvencies and home ownership. And so if we look into CCR data in particular, this is the really important part that's really evolved over the last few years. So comprehensive credit reporting, we receive data every month from 80 entities, varying industries, so banks, telcos, utilities, a lot of non-bank, including buy now, pay later. And so what these businesses tell us every month is how their entire active population of customers has paid their bills. And so this is the really predictive stuff now in a credit bureau that feeds the score, much more than what we used to only be able to see, which was credit inquiries and defaults. Because what we're seeing now is 24 months worth of payment behaviour. So if I had a credit card with one of the banks, they would report that Monika's credit card has a credit limit of $10,000, and this month she paid us on time, or she was 1 month down or 2 months down. And the real power there is that previously we'd have to rely on the default to emerge on an individual's credit file, which is a lag indicator. It takes 3 months plus before we see that default emerge. In the meantime, Monika's getting into a severe distressed delinquency position, which we now have visibility of. So now if someone does an inquiry on Monika and I'm starting to get into distress, we can actually see that well before the credit default emerges on the credit file. So that's really powerful. On the flip side, if an individual has a life event, because life happens sometimes, and they do end up with a default on their credit file or some poor payment behaviour, paying their bills on time will also help them to rehabilitate their credit scores. So that's a really important component to mention. So hopefully that gives you some good background on the data and where it comes from. And now I'll just come into some really high-level insights on credit demand. So this is a little bit busy, the slide, but it tells you by product since January 21, the trends that we've observed with credit demand. So I'll just quickly run through it by product. So you can see the green line, the light green line, that's mortgage demand. So going from left to right, left being January 21, that was at the peak of the market. The market was booming, housing was hot, everyone wanted a house and they were paying big dollars for housing. So you can see that it's much higher than the rest of the trend. And then it drops off rapidly, which is the August lockdown that we had in Auckland in 21. Around the same time, we coincided with LVR restrictions coming in and CCCFA. So there was a noticeable impact on the market subsequently from there. And of course, the last 12 months, we've seen a really sharp decline in housing demand as a result of the tightening of the monetary policy. So that's quite evident in what we're seeing here. Auto loans has been quite steady apart from the lockdown, but more interestingly, over the last few months, we've actually seen an increase in credit demand on auto loans. I think this is largely driven by migration starting to come back into the country. So, we are starting to see a rise there. Credit cards, which is the light blue line at the bottom, that's been quite subdued over time, although we are starting to see a slight increase more recently, probably because the borders have opened up now and people typically use credit cards to fund their spending while they're overseas. And personal loans being the red line and buy now, pay later being the orange line. So personal loans and buy now, pay later both peak, you'll see consistently across that time period, around November, December leading into Christmas, and then they taper off. But buy now, pay later's demand has certainly eased when compared to January 21, probably because most individuals who would use a buy now, pay later account already have an account, so they've just potentially met market saturation. And then if we look into specifically the next slide, which talks about lending amounts. So if you recall, we talked about CCR data providing us actually the amount of exposure, which is really useful when doing CCFA assessments as well. So we can see mortgage lending is down 42% compared to February last year. So it's quite significant. And the chart on the left shows us the variance. So again, the really light green tabs in the middle of the chart there show us the real peak of the market. So that's when the market was hot. Lending amounts were huge because house prices were going through the roof, and there was a lot of activity happening. And by contrast, we can see now the grey lines in January and February, which is this year, having dropped off quite a bit. We're just seeing house prices tapering back. The market's really slow at the moment, so we're just not seeing the same amount of lending going on. On the flip side, consumer lending seems to have increased a little bit over the last year, and we think that's as an impact of personal lending being up with, again, borders being open and people borrowing to go on holiday. Potentially there might be some reluctance to give up lifestyle, so maybe a little bit of help there going on, but and also largely driven from auto loans. There's been a huge impact on supply and demand from auto loans. So second-hand vehicles are up. They're more expensive than they used to be. And I think that's having a big impact on dollar values that have been lent as well. So from here, I was just going to quickly show you some arrears positions. So as we mentioned before, we know that arrears are about 11.9% at the moment, and the chart on the left shows us the trending. So we can see that we're still well below the grey line, which is 2019. So that's our baseline pre-COVID levels. So that's really positive. The other positive news is that although it's up on 2020, 21 and 22, we're still following a seasonal trend. So we would expect to see that arrears go a bit high in January and then they taper off a little bit in February. We haven't got March data yet, so we'll see that in the next couple of weeks, but that'll be interesting to see what that presents. The chart on the right shows the aging of buckets by arrears position. So slightly concerning there is that we can see that people who are going into an arrears position, there's a very small percentage that are actually struggling to get out of the early arrears position and they're deteriorating further. So that's definitely something to keep an eye on. But I think overall the message is, yes, arrears are higher than they have been for the last few years, but overall we're still in a very good position. And I think that the recent changes to CCFA definitely help. So keep an eye on things, but it's not dire by any stretch. And then I thought I would just drill in by product as well, which might just give you a bit of insight of what's going on specifically. So as you can see here, on the left-hand side, home loan arrears, definitely on the rise, but still by historic levels, still quite low, 1.29 currently compared to 1.55 back in 2017. So, we're growing, but it's not catastrophic by any stretch. Consumer loan, that's got quite high at the moment. Again, with the CCFA focus, I think the lenders will be in a really good position to manage that appropriately. And it's definitely something that everyone's taken a really proactive approach to manage from the conversations that I'm having with the industry. Auto loans, similar trend, although not at its peak by any stretch. So just something to keep an eye on. And then on the next page, we've got buy now, pay later, very similar to personal loans with its profile. We don't have as much history for buy now, pay later. Interestingly, we get asked about buy now, pay later a lot, but when you look at the arrears profile for buy now, pay later, it's actually very similar to unsecured lending, so personal loans and credit cards for the same age demographic. So under 30s, the arrears profile is actually very similar. I think it's just that buy now, pay later is very heavily skewed towards the younger demographic, and we know that younger people typically don't manage their money as well as the older generation. So just something to be mindful of. Credit cards arrears profile continues to decline, which is good to see, although it's slightly up, but not anywhere near as where it was in 2017. And again, a similar story for telco and utility. So Things are definitely changing out there. There's no doubt about it. I think, everyone has the same sentiment in the market, and I guess Christine will elaborate on that a little bit further. But I think the industry's got some really good processes and procedures in place to help support consumers in that process. And, it's still tracking really well. So on that note, I think I'll finish up there because I don't want to make it death by PowerPoint, but hopefully that gives you a good sense of what we're seeing emerging in the market. We are keeping a really close eye on it, so we'll be able to continue sharing these insights and as things evolve, just to really make sure that all of you know what's happening.
Great.
Thank you.
Thank you, Monika. Yeah, it's great. And your monthly reports are really insightful as well. And I like the snapshot you're taking from that. Hey, Christine, let's just move over to you. And having heard that, obviously your business is around actually taking phone calls and helping people on the ground that are struggling with debt issues. And yeah, just your views on the market at the moment.
Well, I was very pleased when Monika said that we thought that buy now, pay later had reached their saturation. Our sector have been campaigning to not do away with it, but restrict it more in the CCCFA, obviously, and I understand that there's a change coming. When that will be, not really sure, because seems to be taking its time. But 416,000 people behind on repayments in that slide. That's quite shocking when you think of FinCap, who supports all the budget services. Their figures show that we're only helping 70,000 people in the sector. DebtFix focuses on debt solutions, so we do more complex debt issues. We work with all the budgeting sector. And on a call to a few of them this week, we are all seeing an increase in this first quarter of this year based on the cost of living, the weather events and such like. For us at DebtFix, we generally see about 1,500 clients a year. We've already seen more than 500 in the first 3 months. So that just gives you an idea. It's just shocking figures already. We're already increasing our capability. One of the services reported when they came in on a Monday morning, there were 344 voicemail messages asking for help because they were in hardship. That was phenomenal, because they'd usually probably only get about 20. So there's a great increase in need out there. What we're seeing is that, look, rents were high to start with pre-COVID. Rents were causing an issue. Then we had COVID, so we had a lot of people who were new to hardship, who didn't really know how to apply for hardship. So we were trying to educate them into, you can actually apply for hardship. You don't have to go bankrupt and throw your arms up in the air. There's ways of working through it. And then we had the cost of living increase. And, if you're a worker and you're getting paid, you're bringing home $600 a week, your work hasn't got nearer, but the petrol's got more expensive, and you've still got to put food on the table for your whānau. And it's the same size whānau, but you're now paying, double what you used to pay. We heard on the news last night that the groceries have gone up, 14%, and yet wages, even benefits went up about 7%, I think. So there's a huge disparity there, and that gap's getting just bigger and bigger. We're finding in the budget sector more and more people who are employed coming for assistance because they cannot afford to live on their wage, even though minimum wages have gone up. So we're seeing a lot of hardship out there, and more clients come to us living in cars, because it's, do I pay my rent? Do I buy food? Or shall I just can the house and live in the car and try and manage that way? That's the state that we're at the minute. And that's almost, and I don't want to say this, but it's almost acceptable because they can't afford to do anything else. We're seeing an increase of people on superannuation having to take up a part-time job just to supplement their income. I see on one of the slides that Monika did, 9,800 accounts reported in financial hardship. And that's just those who got through, because it's quite a lengthy process to get into hardship. It's just, I don't know where we go from here, except tell people that there is help out there and not to jump ship. And I mean, like go bankrupt or think there's nothing that we can do. There's a lot of help out there. And there's a lot of people probably on this call today who can actually reach out to their clients and their customers and say, there is help in this space if you're struggling with money. And yeah, I agree, Monika's stats are a real help and guide to us all as well. Yeah.
Yeah, it's really interesting, isn't it? And it's just very sobering to hear that this is a situation where it just seems to be building. Although, Monika, to your point, it's still pre-COVID levels in terms of arrears. Actually, it feels as though it's building and becoming more of an issue. There's one question that just came in from the audience just around credit card arrears and home loans arrears, and the question is around the lower income individuals. So it goes. It's interesting to see that credit card arrears is increasing while home loan arrears aren't that bad. So does that mean that low income individuals are worse off in our economy on current economical situations, and the middle incomes are more resilient, do you feel? Was the question. So yeah, is this hitting lower income individuals more than the more middle income families?
So can you, Monika, go first?
I think there's definitely a tale of two economies emerging. So I think there's definitely the ones on the lower incomes that are being hit harder because they have less flex, I guess, less of a buffer. But I don't have any data to support whether people who have credit cards are better income earners than those that don't. And all I can say is that the CCCFA or responsible lending requirements don't discriminate between product types. So whether or not they're applying for a mortgage or a credit card, the same applies as far as the assessment process goes. But there's no doubt about it that people on lower incomes will be struggling to make ends meet more so than those on higher incomes.
So what we're seeing is actually higher incomes coming to us. Budget services tend to see beneficiaries in low income. At DebtFix, we usually see the next bracket, low to middle income, and we're seeing a lot in the higher middle income bracket now coming through. We're also seeing a lot more failed businesses than we used to, whether it was self-employed sole traders or actually limited companies going under, and we're trying to work through that with the clients as well. So we are seeing an increase in that, and that's quite hard for us because we're one of the only services who will deal with self-employed and business debt. So we do get the majority of them, and it's hard, and we're trying to work through that with them to try and help keep the business afloat because that's their livelihood. But we are seeing loss of houses because of the business, because the lending is secured onto the house for the business. So we're seeing that right now, losing houses because of business failure, and we're expecting to see more people come to us because their fixed mortgage is going to go up and increase their mortgage payments a lot as well. And they probably haven't got that much wiggle room for that in their surplus in the budget, even if they have a little bit of a surplus. So we are expecting another increase when they come through too.
Yeah, okay, so interesting. So homeowners probably going to get a little worse as they roll off their current rates, I guess. Yeah,
absolutely. Yeah.
And just so we talked about sort of low middle income brackets there. What about specific other key demographics? Is there any other prevalent groups that you're seeing coming through or on both Christine and Monika. I'll start with Christine. Is there specific age groups, for example, specific ethnicity groups? Are there any trends you're seeing?
So our age group actually spans quite a wide age group. 26 to 55 is our main. And they're all about the same amounts in each one. Like I mentioned earlier, we are hearing and seeing people on the superannuation having to take up more work because they're now struggling and they're in hardship. So they're having to supplement the super as well, because that's, you can't, whatever they tell you, you'd be a good person who can survive just on the superannuation. You do need a Kiwi saver because it is hard. Even though, 1st of May, the winter energy payment will kick in. That'll give people, $20, $30 a week, but then the power will go up, so that'll cover that. So it's really, people are doing it tough out there. And someone said to me that they went to the supermarket yesterday and for example, saw cauliflower at $12.99. That's a pricey cauliflower. You'd have to bring that last.
Yeah. No, that's right. And it's interesting the idea in terms of the those in retirement, and our data supports that idea that the savings are just dwindling a lot quicker than expected, retirement savings, which is probably exasperating it. And I guess it talks to this sort of short term getting food on the table versus long term preparing for retirement. Hey, Monika, is there anything in your figures that are sort of showing any demographic instances of interest?
Yeah, nothing skewed towards the older demographic. Our data definitely shows that the under 30s cohort is the one that struggles the most to meet their obligations, but not too far out from sort of the next tranche up, so it progressively improves. But I guess at the same time, most of the retired or over 60s population probably don't have as much lending facility. A lot of them might not have a mortgage, so there's less exposure from that regard. So they're probably feeling the pinch day to day with an income, but we're not seeing them translate into credit yet.
Yeah, no, that makes sense, I guess. And
I think you probably will because if you're on the superannuation and you come off a fixed rate and your mortgage payment, I don't know, goes up 50%, your superannuation hasn't gone up any. And that's, that's what we'll be seeing soon term.
And that talks to the for working people, the wage stagnation kind of conversation, I guess, and for retirees having to, like you say, face into, okay, we've just not got enough in our savings or through the super to keep going. Just in terms of the hardship conversation, Christine, you were talking there around educating for hardship. I mean, we've started noticing our Kiwi saver figures that the hardship. More people are looking to or taking hardship out, the hardship withdrawals out into the Kiwi saver. And I just, what are the ways of what are the sort of headline ways of helping people that are in hardship from your perspective?
So we actually do Kiwi saver hardship process for Simplicity and a couple of others at the moment. We're seeing an increase in Kiwi saver hardship withdrawals just for essential costs for food and rent. What can they do? That would depend on their situation. First of all, we'd look at seeing what debt they have and if we could apply for hardship and reduce the payments on the debt. We would like to see, let's have a look at your spending habits. Can we do anything actually there? You're going back to basics, even with grocery shopping. Plan your meals. Bulk buy, make sure that you go with a list and then you're not overspending. I mean, me and my husband went to the shop the other day and it was like over $300 and we were like, oh my goodness, there's only two of us. It's like, what the heck did we buy and how long is that going to last us? And then we went back the next week and spent nearly 200, and that's just two of us. And it's just crazy. So we sort of going back to basics, Remember in COVID when we started baking and started making things and we were walking out on the beach or in the parks for free? We need to be doing all that again and continue that. And making stuff, planning a list, op shopping if we need some new clothes, maybe, really, I don't want to say dumb it down, but really going back to basics and almost how we used to live, back in the day when we didn't have credit and things like that. So it's a big ask for some people. We're also seeing a lot of utilities go to collections, which is quite heartbreaking because people need power, phone and water. So that's another thing that we've actually started seeing come through. So it's just trying to educate people into, I guess, a different way of life and to realise that you can cut your costs. And what is your choice? Do you want to buy, do you want to have this fancy phone, or do you want to actually put food on the table and put power in the tank at home? That it's that kind of thing. But it's making them aware that there are choices, and they don't just have to do same old.
Yeah, and I would echo a little bit of what Christine's saying, just anecdotally. They said the other day that OCR's not been so high for 14 years. So it's a really long time, and an entire generation that hasn't experienced high mortgage rates or a high cost of living, going back to the GFC. So it's actually probably going to take a bit of time to adjust to the higher cost of living and actually learn how to do all those things and not go out for lunch all the time or... I think a lot of people have done that in the past, but it's a big learning for a lot of people. So it's going to take time, and in some cases it might take a shock. But yes, it's just very different at the moment, and it's happened quickly as well.
Yes.
That was going to be one of my questions. Do you feel like if we look back to the GFC and perhaps COVID and now, what's the differences? Is this faster, quicker, harder? Do you feel, or is it of a similar level?
I don't have specific business experience to speak to with the GFC, but what I can tell you is that the arrears rates at that time were early 20%. So, we're at 11.9 now, so we're still miles off. And of course, the big difference with the GFC was a really high unemployment rate as well. Yep. So at the moment, we're really lucky. The employment rate's holding strong. Well, some would say not so lucky because it's driving inflation, but anyway. So, that's, I think, a really positive thing for New Zealanders, because it just makes life easier if you're gainfully employed. If that changes, then we might start seeing a lot more pain occurring. So, yeah.
Yeah, I think for me, back in 2008, if I can vaguely recall it, our clients, well, Detfix wasn't around then, but my clients I had a lot of real estate people on my books because they couldn't sell the houses and they'd leveraged a lot of their money, and so they got 3 or 4 houses themselves. So that was causing an issue, and they weren't selling, so they weren't getting any money in and they couldn't pay the debt. I think this time we're coming off the back of a heck of a lot of other things. So the rents were already rising in 2019. Then we had COVID, where things just sort of ground to a halt, ground down, reduced, and then the cost of living started to rise, petrol started going up, then the food started going up, and everything has just compacted, and we haven't been able to take a breath or actually take stock of, right, everything's going up now, and then of course this year we've had the floods and the cyclone, which has had a huge impact on a lot of the population, that people are forgetting about. We're thinking of this area and this area, but there's a lot of areas that were devastated, pockets as well in different areas. So I think this time, for me, it feels like it's been better because of the knock-on effect of everything else that we've been building up. Everything else is, and it's just been building up on everything. It's been like a snowball, hasn't it? Gathering snow as it's gone down the hill, and we're now at the bottom, and it's huge.
Sure. Yeah, I mean, that compounding, and like I sort of mentioned at the beginning, the globally people are doing it tough. I don't suppose we're on our own. And just a couple of there's a point from one of the audience member, and a quick question. One supporting the tightening up household spending isn't exactly a fun task to do, and can be challenging to reduce your lifestyle. And I guess, you know, one of the comments you made, Monika, that I'd noted down earlier was like borders are open, and people are wanting to go away, and so maybe the balance is wanting to keep their lifestyle, wanting to keep lifestyle choices whilst in potentially difficult financial economic positions there.
Yeah, absolutely. I think there is an adjustment, and it isn't fun, especially when you've been so used to it for so long. So it's not an easy choice, and sometimes people need help with that, but there are a lot of services out there that can help you to budget better, and people should take advantage of those.
Yeah.
And sometimes it's not a case of specifically cutting down, it's just like changing how you do it. You know, we're not asking you to cut down your phone plan, but hey, if you check your phone plan, are you actually on the right one, or actually is a better one cheaper? You know, it's just making you aware of those things. You know, how much you're paying for your insurance. Have you checked it recently? It's sometimes it's as simple as that. And you know, you see this what's that TV program, Eat Well for Less? You know, have a look at what you're buying at the supermarket. Do you have to buy the brand that's the most expensive on the shelf when there's 6 others there that could be as good? So it's all about making people aware of the different choices, and maybe just changing a couple of things up a bit, you know, and then seeing what difference it's made. Some people think that like $10 a week, oh, well, let's not bother, let's just buy that big brand. But actually $10 a week is $500 a year if I've done the sums right, you know, and that's quite a difference at Christmas as well. So it's every little counts, and if we can make small changes, they don't feel as hard as bad.
Yeah, interesting. An interesting question here around the upcoming election, and is there anything you'd like to see policy-wise, the government or potential government changing to address some or resolve some of these challenges in the future? One of the states. There's another question was maybe it's time to advocate for compulsory saving and KiwiSaver, but I guess again we've got this sort of short-term versus long-term issue about, you know, being able to afford the cauliflower versus saving for your future. Yeah, just wondered whether you thought there was anything that government might be able to think of or do differently, was the question.
So my personal view is I think it'd be great to have a compulsory KiwiSaver scheme, and I think that's really important. But I think there's also a danger as far as policies go in making a lot of changes all at once without understanding what the long-term implications are. And, you know, OCR being a good example of that. It's been very short and sharp, and just giving it time to sort of actually have an effect and understand what the unintended consequences are, I think are really important as well.
It's those unintended consequences, isn't it? That, you know, let's raise the minimum wage, which is great. That's awesome. However, now you've got a lot of businesses struggling to meet that criteria, and has that had a good knock-on effect in the economy? Time will tell. You know, it's and actually with, you know, the cost of living, was that inevitable? Prices always go up. Fuel went up. There were shortages, shortage of supply over COVID.
Hey, I just wanted to move on just a little bit into this idea, Monika, that you talked about migration and immigration might be affecting some of these stats and figures. You know, is obviously the borders are open, so perhaps people are sort of going on holiday more. But what's the impact you're seeing in terms of migration into the country, specifically around, you touched on it around auto loans potentially and that sort of area, but just wondered what your view was and how much migration is affecting the credit and debt scores, really.
So we have observed, so the way we measure this is by what we call a new to bureau application. So that's when someone applies for credit and we've never seen that person before. So that's often someone who's just come of age, so they've just turned 18 and they're starting to get credit active, or more often than not, migrants as well. And so, of course, that has been pretty non-existent for the last few years, but we've definitely seen an increase over the last couple of months. So we've got credit information on probably 95% of the credit active population, so pretty good coverage, but we can't get it all for that reason. And so we can't score those individuals because we don't know anything about them. So basically we just return a flag back to the credit provider to say, hey, we've never seen Monika before. And then they will sometimes do additional due diligence to satisfy themselves that the person is creditworthy or is who they say they are. So,
yeah. Interesting. And from your perspective, Christine, any sort of migration, people coming to New Zealand on to work? Is there any of that coming through from your perspective?
Hopefully not, because we do them for irresponsible lending. Yes.
Fair enough. Cool. Of course. Okay, cool. No, that's really interesting.
For them coming in, because some of them aren't prepared. They aren't prepared for the costs. I wasn't prepared for the cost when I came here 19 years ago. 19 years ago it was expensive, so today it's really expensive. Yeah,
no, absolutely. Cool. And then I've just got a question here from the audience. It's around the OCR increases, and are they actually making much of a difference from your perspective in reining in spending, or at the moment? Because it feels like there's still, or the news is reporting there's still spending going on. I guess, the question at the end of it is should there be other tools we need to be explored to control inflation? But it's quite of a big question. But yeah, do you feel that the OCR is actually having an impact, the impact from what you're seeing from your data and your conversations? Christine, I'll start with you.
Yeah, not from my side. I think the people that we see, they would be borrowing money, whatever the OCR said, did, or any of the interest rates. I'm sure they would still be borrowing money. So I don't think that has an effect on the people who are struggling right now, or either in a lower hardship place.
Yeah, and from our perspective, and from my perspective, it's a bit of an economist question, isn't it?
Yes.
I think that the individual's absolutely right. The OCR is one lever that is being pulled, and there are probably others that should be pulled, which will have a broader impact. And the messages are a bit mixed from retail. So, we are seeing large ticket items slowing down, but smaller ticket items are still good, and hospitality still seems to be going well. So again, is there a reluctance to start pulling it in? But I think there's still a large number of mortgages that roll off onto new rates for the rest of this year, which might have a bigger impact than we've seen to date. So unfortunately, it is a lag. So they can make a change now and we might not see it for 12, 24 months. And in the meantime, inflation just seems to be rising. So hopefully we start seeing a difference there.
And retail might start seeing a boost for the bigger ticket items because of all the houses that were lost and all the furniture needs replacing. So we probably see that coming through soon too.
Yeah, interesting. And I guess on the housing side, you talked about, Christine, when you were talking around sort of what the trends are in terms of what you're seeing. You're seeing some failed businesses and that their business loans are attached to their housing. I just wondered from the other side, thinking about people that are renting, are people seeing rents increase substantially, perhaps because mortgage or owners are seeing the effect of the OCR? It's just as I wonder whether there was a reflection from the other way around.
So we haven't started to see that yet, but that is a good possibility. Obviously, the landlord has to give quite a bit of notice before they put the rent up. Some maybe 12-month fixed term rents. So that might be the saving for this year, not for the landlord, but for the tenant at least. But, you know, our biggest hit with the rent was when they introduced healthy homes. And I think the tenancy people and that sector all said the rents are going to go up. And the other side said, oh, no, they won't. And yes, they did go up. So I think that was a big jump. So whether that's gone up enough, and it will be a lesser increase this year. But I guess throughout the year, like Monika said, there's more coming off fixed. And if they haven't planned for that, then it will be no doubt passed on to their tenant.
Yeah, and look, I mean, all I can say is that I guess if the landlord's experiencing increased costs, then it'll probably be passed on. I mean, I don't know, but they may not be in a position to absorb it all, so they might have to pass some of that on.
Then there's nowhere for people to move to because we've got a housing shortage, so they are moving into the cars, and it's not healthy, which is a knock-on effect to our health system. So it's all this, just this merry-go-round.
Yeah. And it's the idea of financial, like research we do, financial well-being has a direct impact on physical, mental, and overall well-being as well. And that's they're the levers that you're talking around there, aren't they? Which is difficult. Okay, and just another couple of questions, and then we'll bring this to a close. But one of the questions I had is an industry. Obviously, we're all working within this industry. What do you think we could do to collaborate better as an industry to sort of help and support New Zealanders going through tough times?
I think for me, can we just make sure that where there is help for your members and your clients and your customers, and even maybe make sure there's something in the newsletter for those who won't come forward, because there's a lot of silent people suffering in silence. So just make it part of your marketing, your monthly email. If you need help, there is help out there. There's money talks, there's debt fix, and we can make sure that you get to the right service that you need. Either of us, we've got a free phone number, but there is help out there, and they need to feel that they need to know that we all care and we're all here to help.
Yeah, I agree. It's just spreading the knowledge, and unfortunately, as a country, I don't think we do very well at, building knowledge up from school level in financial resilience and literacy. So really, it's up to the industry to try and educate. So fortunately, there's good networks out there with financial mentors who are talking to people, and hopefully they pass that knowledge on to their family and friends. And, I know that when people come to our business with inquiries on what's on their credit report, we definitely have that information available and we refer them to these institutions. So I think we're all doing our part, and it's great to see. But if we just keep pushing hard and make sure that those that aren't contributing do contribute, then it'll have a much better outcome for all of New Zealanders. Yeah,
that's great. And I think everybody working in the industry and everyone in New Zealand, the support is there, and it's about how we can help people access it. That's great. And I just think, just in closing, the sort of last sort of question, I mean, obviously, things will get better and markets fluctuate and we undergo cycles, and people doing it tough doesn't mean we're always going to be doing it tough. It's challenging now, but eventually hopefully the pendulum will swing the other way. Just where do you see this being in the next sort of couple of years, in terms of, we've talked a lot around things are actually sort of indicating that people are doing it tougher. What's your view in sort of 2 years' time? Where do you think the pendulum might be on the swing? Monika, I'll start with you.
Look, I don't know about 2 years' time, but I think things are going to get a little bit harder before they get better. And I guess my message would be just, to really encourage individuals to talk to their credit providers. They are all there to help. No one wants you to get into debt. They all have programs in place to help you through this. So I think it's really important that as an industry we encourage that as much as possible. And I know there's a stigma attached to being in a position that you can't pay. But burying your head in the sand is the worst thing that people can do. So, and the earlier they get in, the better. So, don't wait till you're really in trouble. Get in early and ask for help.
Yeah.
Yeah.
Good advice.
Yeah, definitely agree with that, Monika. The earlier that people call out for help, the more choices that they'd have as well. I think, this year is going to continue to be tough. Hopefully, next year will start to change slightly as people are settling into the hardship that they're living in, and learning to live on a lesser budget and things like that. Hopefully, this is the trough, and we're slowly climbing up the other side now. But it'll be another 12 months before I think that before we see definite changes. Hopefully, I'm wrong. Hopefully, sooner than that.
Yeah, great. Oh, that's really interesting. Thank you so much, both Christine and Monika, for your insights. Just really seeing this from the lens of credit and the lens of debt, and the cause reaction again has been really, really inspiring to hear. And it's a tough subject, and like you say, it's likely to continue to be tough as we continue through this year. So I guess just to reiterate to everybody out there, Money Talks is a great free service, as is Debt Fix and Centrix.co.nz. If you want to have a look at, check your credit report, they're all there for you. So we're going to close the webinar off now and just say thank you very much. Our next webinar is on the 2nd of May, which is around the good governance and encouraging ethical and effective action. We also have an interesting conversation on the 3rd of May, which is a breakfast event where we're getting some economists, Sharon Zollner from ANZ and other experts to run a panel with talking around the economy and our and if we are in recession, which will be really interesting. So have a look on the website for that. And hey, just a reminder that our conference is live. We always have great sessions at the conference and around all these elements. So there'll be a good chance to keep tracking how we're going. But on that note, thank you very much, Christine. Thank you very much, Monika, for your time today. And thank you very much, everyone, for your questions. And we'll see you next time on FSC Connect.